Hello everyone. Today we are going to learn the true convention of the accounting, that is concept of materiality and the consistency in accounting. So what does exactly the concept of materiality means? The materiality concept says that only items whose omission or misstatement could affect the decisions of users may be owners, creditors or regulators, must be recorded and disclosed in detail. Very small or insignificant items can be treated in a simpler way or even aggregated if it does not mislead because the cost of perfect accuracy is not justified. The there are dual factors. The judgment consider both qualitative thresholds and quantitative aspects. For instance, we can take a real life example of a $25,000 equipment purchased is highly material for a small firm with a 5 lakhs in revenue, but negligible for a multinational company or the corporation with a 500 million in earnings. So, the one of the real life example of materiality is consider. So let us consider a company purchasing a $20 water basket. Technically, this is an asset with a useful life of exceeding 1 year. It might suggest a depreciation. However, due to its immaterial value, most company would expense the water basket immediately rather than depreciating it over a decade. As we all know that the cost of an asset is distributed among the working life. So if the uh, asset is purchased for 1 lakh dollars and it will work for an 10 year, so every year the cost of asset is added with a $10,000. So in the same way, the rationale is simple. No investor or creditor would make a different decision based on whether a $20 basket was expensed or depreciated. Larger firms frequently set materiality thresholds, example a $2,500, below which assets are expensed for accounting simplification. So, the advantages of materiality is it saves time and cost by avoiding detailed tracking of trivial items, making reporting more efficient and practical. Also, make statement clearer and more relevant by highlighting only significant figure that matters for decision making. So the disadvantages of the materiality is involves judgment. Different accountants may set different thresholds, so there is risk of inconsistency and disputes with the auditors or regulators. If misused, a firm might label important misstatements as immaterial to hide problems, reducing reliability of financial statements. So, the consistency principle in accounting means the consistency concept requires a business to use the same accounting policies and the methods. For example, same depreciation method, stock valuation method from year to year. So, the consistency is methodological application, requires a consistent application of accounting methods across reporting periods. So it is comparable in nature, ensures financial statements remain comparable, allowing for meaningful trend analysis and disclosure. Any changes in accounting method must be justified, disclosed, and explained. This principle guarantees that stakeholders can reliably compare an entity's financial performance over year, fostering trust and informed decision making. So, the advantages of an consistency is improves comparability of the financial statements over time, helping others to see trends clearly. Also, increases confidence because policies are stable and not changed just to manipulate the profits. As there are advantages, there are also disadvantages. So it can make it harder to adopt a better method quickly because frequent changes reduces comparability and may confuse users. If a firm clings to a outdated method only for consistency method, the accountants may become less realistic or less aligned with the new standards. So let's see the real life examples of the consistency. So For depreciation, suppose a company ABC Limited consistently uses the straight line method for all the assets. A switch can to a reducing balancing method would require clear disclosure of reasons and impact. So, from the examples, we get to know or conclude that there should be a consistent method should be followed, and if you change the method with time, so that must be disclosed and have a clear and must be justified. So, the why the materiality and consistency matters. Materiality focuses on the significant, ensure financial reports provide only information significant enough to influence decisions, preventing clutter from trivial details and making reports more useful. Whereas consistency is used for a reliable comparisons, provides comparable and reliable financial data over time, crucial for accurate trend analysis, performance evaluation, and effective auditing processes. Together, these principles underpin the reliability and the transparency of financial reporting and aligning with the gap standards and enhancing the stakeholder confidence. So, impact on financial reporting and decision making. So, the material thresholds the guides the accountants in reporting significant items, streamlining the financial statements preparation process, whereas consistent method prevent misleading fluctuations in reported financial results, offering a clearer view of an entity's performance. And it the investor confusion, a sudden undisclosed change in a depreciation method, for example, could obscure the profitability trends, confusing investors and the stakeholders. These principles are vital for fostering investor confidence and enabling the accurate economic decision making. So, while concluding, applying materiality and consistency for reliable accounting. So, the foundational principles they ensure financial statements are both transparent and reliable. Professional judgment critical for assessing materiality within context and maintaining consistent policies. It the stakeholder confidence. Proper application builds trust and support uh, sound financial decisions. So this is all about the concepts or the convention of an accounting, consistency and materiality. So see you all in the next video.